Hi, very good morning. In today's video, we'll be talking about financial planning for individuals. Now, what is a financial plan? It's very simple. I have certain goal which has to be achieved at a later date. And to achieve that goal, I need money. And to achieve that, I need to have certain saving plan in place. So, let's say a future goal for my child's education. I need certain money. For example, 1 crore is needed for the child education at a later date, maybe 10 years down the line. So how much I should start saving right now to reach that goal? Or child's marriage, or maybe your holiday vacation, or buying a property. It could be any financial goal. So that exactly requires planning, saving, and where to put money, and how long the money should be put in what asset class is called financial planning. It seems simple, but a lot of people are just not aware how to exactly reach and do this financial planning. So I've tried to capture this in a small module today, try to keep it as crisp. So we basically talk about the financial goals of an individual. So the financial goals of an individual could be buying a house, property, any asset to acquire at a later date. To achieve that, you need certain amount of money, time, and you need the right kind of investment avenues to reach that goal. Okay. Now, your goals or financial goals should be very clear. That means specific, measurable, attainable, relevant, and time based. Now, I will make you understand that if you basically start saving small amount of money at regular intervals, through the power of compounding, you can reach your goal much faster than putting your money in a typical saving bank's account, which will hardly earn you any amount of money. So, before we do that, we need to also understand that from today, if you think about meeting any of your goals, let's say retirement or travel or education, you need to understand that the cost of achieving that goal will be substantially higher in next few years because of inflation. Today, let's say for example, if I'm thinking about retirement, I may need X amount of money, but 20 years down the line, because of inflation, I may need 5x of the money. So I need to plan accordingly and start my savings from this point of time. Okay. Now I will come to a very interesting slide. So what's basically again called value of money or inflation. So let's say 1990, you were able to buy 20 or 30 goods with a 500 rupee note. The same 500 rupee note would only buy you 10 things now. And maybe in next few years, it will be able to buy you even lesser amount of goods. So the value of money keeps depreciating because of inflation, as I explained. Okay, now another interesting thing, let's say you had 50,000 rupees kept in your box. So after 10 years, it will be valued at 27,000. After 15 years, it will be valued 20,000. And after 25 years, it would be valued only 10 or 11,000 rupees. Okay, now I will teach you about certain important avenues where one can invest your money to get your desired financial goals. Firstly, bonds. Then you could invest in mutual funds, public provident fund, stocks, jewelry, property, and even bank deposits. Now, all these are just examples of few avenues which are really common amongst people. There could be other avenues also, but mostly people prefer these avenues. But the return in each avenue is different. Like in bank fixed deposits, it could vary. Now it's currently 4.5, 4.75, very low. At one time, bank FDs used to be doing well, maybe 6.5, 7. Then property is not giving any return but has a overall value in terms of appreciation. That could be an asset. Provident fund is good, it gives you certain amount of return. Bonds are also good. Individual stocks could be risky at times if you don't know how to trade. But each asset class has its own challenges and advantages. So you can use a mix of these asset classes to kind of get your desired returns. Okay, in this session we'll be talking mostly about the most preferred asset class amongst individuals, which is called mutual funds. Now in mutual funds, basically they invest in equity and debt securities, and the money is invested for a certain period of time. Of course, you can withdraw the money at any point of time, and the money that is invested in equity or debt will give you a certain return. So that return could be in the range of 5, 6, 7, 10, depending upon the kind of investments which have been made. So mutual fund basically would invest your money into a fund which is mutually created and which invests into equity and debt oriented investments. Now, what is equity? Equity could mean your shares or market linked equity instruments. What is debt? Debt could mean Government of India bonds. It could mean other avenues of corporates, corporate fixed deposits. So this mutual fund invests on your behalf in these securities, and its value keeps increasing over a period of time. And whenever you want to redeem it, you get your desired corpus back at a good rate of return, depending upon the kind of investments which you have made. Okay. Now these mutual funds are managed by professionals and are reviewed, and the costs are very reasonable, and they are strictly managed by SEBI, so to safeguard investors. So very safe avenues. Now we will come to category of mutual funds, which is basically classification: short-term funds and long-term funds. So there are certain funds which invest for short period, depending on the mandate, and certain which invest for long period of time. Now, as I explained earlier, mutual funds basically is a collective pool of money which is available to the fund manager on behalf of investors, and that's where he invests this money into various asset buckets like equity, like debt. Then there is something called as a balance category, which will include certain investments in equity as well as debt, which is called hybrid, which is also important asset class. Now, for conservative clients, if you have to put money, you could also, apart from your fixed deposit, put into debt mutual funds, as I've explained. Now, what are debt mutual funds? They invest in fixed securities, government bonds, it could be corporate bonds, it could be any kind of fixed instrument, aims to give you a fixed income and suitable for conservative kind of segment. Equity will invest in equity. Equity mutual funds would invest in equity related instruments of companies with long-term growth. Of course, they could be volatile in short. So it is suitable for people who have a higher risk appetite and longer investment horizon, maybe 7 to 10 years kind of investment horizon. Okay. Then we will talk about hybrid funds, which I told you will be a blend of equity and debt. Now, what happens is people have to kind of understand, as I said in the beginning, that to reach your financial goal, you will have to manage your investment in such a manner that there is a proper asset allocation, which means that not all money should be put in one particular investment type. That means either mutual funds or only bank FD. So you have to diversify. You could buy a small property, or you could invest some money into mutual funds, some into bank fixed deposits. All of this would help you to diversify your risk and thereby give you the preferred kind of return which is there, which is what we call an asset allocation strategy while managing your financial goal. Okay, now after asset allocation, we will be covering an interesting thing called taxation. Now we need to understand that if you are an individual and you have certain tax slabs which would be applying to the taxes that you pay, the same amount of taxation would also be relevant if you invest in equity and debt mutual funds. But there is a benefit if you hold your investments for longer period of time. like in equity, if you hold your investments for more than 1 year, the tax would be only 10% on the profits. And if you hold for less than 1 year, it will be 15%. Similarly, for debt, if you hold for less than 3 years, the taxation would be as per your tax slab. And after 3 years, the taxation would be 20% with indexation benefits. So this covers very briefly about the taxation aspect. Now, how should one invest money? Should I invest in one go, which is called lump sum? Should I do it through a SIP mode? That means systematically I invest every month some amount of money. Well, the answer is obviously depending upon how much money you have and how much risk you can take or comfortable you are. Let's say you're not comfortable putting all your money in one go. Then you can put it systematically. Every month put small saving, which we called SIP, in these suggested mutual funds. Okay. Then obviously, apart from this, you will need to have various kind of funds like mutual funds. Let's say, for example, if you need short-term liquidity, maybe 3 years, 3 months, I beg your pardon, or 6 months down the line, you can invest in short-term debt funds. But you have a long-term goal of your child's marriage, then put in equity with long-term 7 to 10 years horizon. So you will have to choose the mutual funds depending upon your requirement in future. Now, as we usually say in all presentations that every investment is subject to market risk. So you need to understand there is an element of risk investing in any asset class. There is no guaranteed returns in anything. However, in mutual funds, the risk is minimal. But again, it depends on the kind of mutual funds you choose. So you have to understand that debt funds would have relatively lower risk and equity would have relatively higher risk. Now, when we talk about guarantees, there is nothing like guaranteed returns in any asset classes, even in fixed deposits. If tomorrow a bank were to go bust, you will only get your 5 lakh rupees back per account, per PAN holder. So we have to be cautiously aware of where we are investing money for long-term wealth creation. Okay, now I would skip few slides, but I will like to share a very interesting thing which came in my mind. So if you start in your investments early in mutual funds, what happens, for example, let's say I've started my investments at the age of 25. So what happens if I'm starting early? And let's say I'm investing 10,000 rupees per month through a equity mutual fund or SIP. That 10,000 rupees, you would not believe, would reach a figure of 5.5 crores at the age of 60. Which is my retirement age. If I start slightly later at 35, I would need more money, 14,000 rupees. And then also I would reach 2.3 crores when I'm 60. And even more money, let's say 23,000 if I start at 45 years of age and only reach 1 crore when I reach 60. So the later you begin in your investment cycle, the lesser would be the return. Obviously, because of power of compounding, lesser time, so lesser amount of time, so money will not be able to work that fast. Okay, now let's say what exactly we mean by power of compounding is explained by a very interesting example which I keep giving. Let's say you have 1 lakh rupees invested at 12% compounding. Compounding means every year, let's say on 1 lakh you get an interest of 12%, so it becomes 1,12,000, and in next year you get 12% on 1,12,000. So that is called compounding. So what we understood from this is that the power of compounding is very critical in multiplication of the value of money. So let's say in 5 years, 1 lakh would grow to 1,76,000, but the last few years, let's say last 5 years, because of power of compounding, this additional 12 lakh rupees on the money which was available gets added in the last 5 years. So what I'm trying to say is, in the initial 5 years, money grows slowly, but towards the fag end of the cycle, the money starts multiplying much faster because of compounding. Okay, now I will be skipping a few irrelevant slides, and I'll be covering more on things like SIP we've already covered. Now we'll be covering about briefly about how SIPs work. So every month you invest certain money. At every level, the money is invested in market. So depending upon the market levels, be it high or low, you get an average investing price. So that is the advantage of investing through an SIP. A SIP tries to give you that averaging and gives you much better returns than a lump sum investment at a particular point of time. Okay, now we've covered mostly about SIPs, and then there are other things which we can do is tax planning through ELSS, which is very important. So let's say I have a certain tax burden. So mutual funds allow you to save your taxes by investing in mutual fund ELSS called equity linked saving schemes. So 1,50,000 under ATC can be claimed as deduction, and the money is invested in 3-year lock-in equity linked schemes. So your money is safe, your money is invested, and you're getting tax saving also through mutual funds. Okay, now we've talked about various ways and things about mutual funds and all, but I briefly would also like to cover about retirement planning. A lot of us want to retire rich, and we want to ensure we need to meet our expenses, have a good lifestyle, and how do you do that? And the most important thing in mind is I'm still young. um, I am not an expert. How will I do? I will require a lot of money. Mutual funds only invest in equities. SIP means you will never lose money. So these are all myths which are there. The crux of the matter is very simple. The sooner you start investing, the better would be the chances of you getting a good retirement for you. And when we are young, we don't realize it. But by the time we reach our middle age, we have missed half of our journey in investments. So you need to understand, if I sum up this presentation, that every goal or financial goal of yours must have its own asset allocation and a proper financial plan backed by your risk profile. Mutual funds would help you achieve this goal. They're very helpful because they're properly managed by qualified professionals, and they will invest according to the type of mutual fund which you invest. And do not ignore the power of compounding which is available, and use a regular systematic approach towards investing and meeting your overall financial goals. Thank you very much, friends. This was a small brief capsule on financial planning. I hope I've tried to cover and make you aware of the importance of financial planning. Thank you very much and stay safe.